welcome to this explainer. Today, we're diving straight into the mechanics of the Axis Large and Midcap Mutual Fund. We're going to break down exactly how this specific fund tries to balance the rock-solid stability of established market giants with the explosive growth potential of emerging companies. So if you've been wondering how to smartly position your portfolio for the long haul, let's just get right into it. Here's our quick roadmap for today. We'll start by defining large and mid-cap funds, then track historical performance, contrast this fund against its peers, analyze the volatility and risk, master some key metrics, and finally, look at the long-term capital advantages.
Starting with Section 1, defining large and mid-cap, or as I like to call it, the anchor and the engine.
So, according to SEBI regulations, market caps in India are pretty strictly defined. Large cap companies are the top 100 businesses. Think of massive giants like HDFC Bank or Infosys. These act as our stable anchor. On the flip side, mid-caps represent the 101st to the 250th companies. These are the agile, much faster-growing businesses that serve as the high-powered engine for your portfolio. And combining these two is exactly why this strategy works so incredibly well, especially for conservative investors who still want real growth. The Axis Fund actively hunts for the best opportunities in both established and emerging Indian companies. But here's the kicker. It also adds a really interesting layer of global diversification. Having that exposure to international markets is structurally designed to help you better withstand any sudden localized shocks.
Moving right along to Section 2, tracking historical fund performance. Because, well, the proof is always in the numbers.
Just to give you a sense of the sheer scale and footprint we're talking about here, this fund currently manages a massive 15,582 crore rupees in assets. It's been around since October 2018, and in that time, it has built up some serious investor trust. And in the financial world, an asset size of that magnitude is usually a pretty strong testament to the market's belief in a fund manager's overall strategy. And looking at the data, that trust is definitely well placed. Since its launch, the fund has delivered a highly impressive compound annual growth rate of 18.63%. So, mathematically speaking, it has successfully compounded wealth and navigated through multiple, often tricky, market cycles since late 2018.
Which brings us to Section 3, contrasting against peer funds. Let's look at its competitive edge.
Now, what's really fascinating here is the consistency. Look at the short term. Over a one-year period, the Axis Fund generated a positive 4.43% return. Meanwhile, the category average actually dropped to a negative 0.38%. That is some serious resilience right there. And when you zoom out to the 3-year and 5-year periods, the Axis Fund's annualized returns of 16.54% and 15.00% consistently blow past the broader category averages. It isn't just growing, it's actively beating the pack. Okay, let's jump to Section 4, analyzing volatility and risk, or diagnosing the bumps along the way. Because no investment goes straight up forever, right? You're probably wondering, what actually happens to my money during recent market volatility? When the broader market takes a sudden dip, how does this fund protect the capital it's worked so hard to grow? Well, for conservative investors, risk management is absolutely paramount. The fund managers here use a really holistic strategy. They manage market risk by closely monitoring price fluctuations. They handle liquidity risk by making sure they hold highly traded assets. They keep a close eye on counterparty risk so trading partners don't default. And crucially, they tackle concentration risk by heavily diversifying across various sectors, meaning if one industry takes a hit, it doesn't sink your entire portfolio. Now for Section 5, mastering metrics for beginners. Let's look at your diagnostic tools. If you're assessing long-term capital growth, your very first diagnostic tool should be standard deviation. Just think of this as the volatility measure. It basically shows how much the returns deviate from the average. At 14.21%, this fund's performance is significantly less volatile than its category average of 16.89%. Put simply, a lower standard deviation means a much smoother ride for your capital. Next up, we have beta. This measures portfolio risk relative to the whole market. Now, the broader market always has a beta set at exactly 1.0. This fund, however, sits at 0.90. That means if the overall market hits a rough patch and gets bumpy, this fund is historically designed to be 10% less volatile. It literally acts as a heavy anchor to cushion your fall. All right, final section, number 6, long-term capital advantages and the calculated strategy behind them. This calculated advantage is perfectly illustrated by a metric called alpha, which for this fund currently stands at 0.71. Alpha is essentially the excess return a fund makes compared to what you'd expect based on its risk level. Seeing a positive number here is absolute mathematical proof that the fund managers are generating excess returns. They aren't just passively riding the market wave, they're actively adding real value. By carefully balancing that high-quality, large-cap stability with emerging mid-cap growth, this fund creates a truly efficient engine. But its key advantage over other options is its specific design for investors who have a 5-plus-year horizon. The magic of compounding, when paired with this kind of risk-managed strategy, simply needs time to work its magic and smooth out those unpredictable market cycles. In fact, as one institutional report recently concluded, this unique combination of a low beta and a below-average standard deviation provides excellent downside protection during market corrections. That's exactly what makes it such a solid choice for long-term capital growth, especially when your focus is on a stable, risk-managed profile rather than just chasing reckless, high-risk growth. So, now that you understand the mechanics behind all these risk and reward metrics, it's time to take a hard look at your own investments. Ask yourself, does your current portfolio have the right balance of a stable anchor to protect you, alongside a powerful engine to grow your wealth for the long haul? Thanks so much for joining me for this explainer. Keep learning, keep questioning, and keep evaluating those financial strategies.